What's up everyone? By the end of this video, you will know what a late cycle market entails, which sectors perform the best in this market, and one huge trap that retail investors fall into almost every single time. Imagine that you have a car loan of 10 lakhs going at 10% per annum for a monthly EMI of around 20,000. If the Fed raises rates by 5%, the same loan goes up to 15% per annum interest and your EMI increases to 25,000. This means you have 5,000 less per month to spend on anything else. The same happens to companies. See, when interest rates are high, companies need to reduce their spending to cover those interest costs. As such, growth slows down. Somewhere down the line, this forces the Fed to cut rates so that growth can be fostered again. That is a late cycle period. Technically, a late cycle market should be good. It should be good for the economy, the stocks should rise. But, as always, someone, somewhere, always messes up and causes an accident. See, the companies that were low debt and managing their costs well can get through the seesaw period pretty well. But if you could barely afford your 20k as an EMI, 25 becomes virtually impossible, forcing you to then borrow more money to pay off this existing loan. If the rates stay high long enough now, let's say 12 months, you would have borrowed 60,000 more to pay off the extra 5,000 per month. These loans also come on at higher interest rates because you already were not in a place to pay off your original loan, meaning a lower credit score. So, even after the rates decline, you still have to pay, of course, the primary 20,000 in EMI, but you also have to pay the 60,000 and interest that you borrowed in the last 12 months. Now, you have to understand that for companies, this is happening in the scale of thousands of crores. So even if one of the giants believes that they are better than the system and becomes overambitious, they take the entire market down with them. This is how market crashes happen every single time in the late cycle. Since the 1970s, the late cycle has led to a severe market crash every single time. This is also why the RBI has been so strict with the NBFCs and even giants like HDFC Bank. They're trying to control the inevitable crash that will come. Where and who will crash is very tough to figure out, but something will break. So this is why late cycle markets are so volatile. Those in the know are pairing their stocks, positioning themselves defensively, while the retail investor believes that there is no end to this bull cycle. This is when everything goes. That's a trap that retail falls into almost every single time. So I will be selling once the Fed cuts rates and the stocks start rising. But hey, I'm not a registered SEBI advisor, so I recommend you to do your own due diligence before investing. Until next time.